All right, let's talk about Fnilx. It seeks to provide investment results that correspond to the total return of a broad range of large capitalization U.S. companies. The fund's inception was September 13, 2018. There's no minimum to invest. Some pluses are the fund has no fees, commissions, or minimums, which makes it a compelling choice for long-term investing. Fnilx holds the 500 largest domestic companies, so it is similar to the S&P 500. But with less structure and more efficient market theory. If the largest companies continue to outperform the broader market, Fnilx should outperform the SPY before fees and without having fees. Fnilx is likely to be a great alternative for former 401k investors that rolled over to an IRA at Fidelity and who are looking to exchange their old equity funds into lower fee alternatives. Again, it has 0% expense ratio. That really saves a lot of money, especially over a long period of time. It has 518 holdings as of December 31st, 2021. Its top 10 holdings make up 28.55% of the total portfolio. We have Apple, Microsoft, Amazon, Google Class A, Tesla, Google Class C, Facebook, Nvidia, Berkshire Hathaway, and United Healthcare. Here we have the ratings from Morningstar. Overall rating is 4 out of 5 stars. Its returns are close to high, its expenses are very low, and risk is in the medium. Year to date is down 5.16%, average annual return for 1 year is 14.37%, 3 years is 19.05%, and since its inception, it has a 15.43% increase. Where SPY arguably snubbed Tesla earlier this year, Fnilx actually already included Tesla back in 2018 when the fund started. This simpler and possibly harsher disqualifier means Fnilx is likely to have higher turnover than SPY, and may be susceptible to greater concentration risk. Nonetheless, Fnilx may include future SPY additions well in advance of the index, and it also might include future removals beforehand. Despite this, the two have highly similar portfolios, with Fnilx generally slightly outperforming during this recent rebound and apparent melt-up. Market weight matters most to Fnilx, like most traditional total market funds, but it is also restricted to 500 companies, like the SPY. The premise of modern portfolio theory would arguably presume Fnilx is a superior vehicle to the S&P 500, because most of the differences between the two would end up involving SPY having greater manager meddling. Long-term index investing presumes such tinkering has greater potential to actually result in underperformance than in the outperformance over extended periods of time. If there are no fees, how is Fidelity making money off of these funds? Well, this product is arguably something of a loss leader that Fidelity released in an effort to accumulate customers and assets under management. Fidelity would do this with the expectation of providing future services, as well as continuing to grow their total AUM. But there is more to it than that. Fidelity can probably make money off of these funds by lending out some of the securities. Fnilx is most likely to be held by customers that buy and hold. Further, these investors are unlikely to use margin. As a result, these funds are uncollateralized and Fidelity may be able to lend them to short sellers as a supplemental source of income. Fnilx is a mutual fund, so your only option for buying and selling shares is at the market's closing price. This is generally accepted by long-term buy and hold index investors, but traders will deeply dislike that characteristic. This restriction is generally irrelevant to the long-term investor that does not track the market's every tick. It is likely to be a more popular choice for retirement accounts. In conclusion, Fnilx has the potential to actually outperform the S&P 500 over an extended period of time due to its simplicity and lack of fees. While the fee savings is minimal compared to SPY, it will add up over time. It is unclear whether the minor differences in portfolio composition will be a benefit or a liability, but Fnilx's approach may also outperform. This advantage should be even more meaningful if Fnilx is compared to the average mutual fund that investors may have in their rollover IRA. If it is true that few professional managers are likely to outperform the market for an extended period of time, Fnilx should outperform most professional managers even before considering the fee advantage. Don't forget to subscribe for more videos like this and to help me grow my channel.